All right, listen up. Future millionaires and market crash survivors. Ever felt like the financial world is just a giant game of hot potato with your money? Well, you're not wrong. Today we're diving deep into the hilarious, often terrifying, but ultimately profitable science of market crashes. Because guess what? They happen. A lot. And while most people are crying into their cereal, a select few are getting ridiculously rich. Want to be one of those few? Buckle up. Intro, the Market Crash Survival Guide, or How to Get Rich When Everyone Else Panics. You know how every blockbuster disaster movie starts with a subtle warning sign, like a tiny crack in a dam or a weird growl in the jungle? Well, major market crashes are the same. We're talking 1929, 2000, 2008, 2020, even 2022. Every single time, three things happen. 1. Most people lose money, like a lot, enough to make you question your life choices. 2. Some people stay exactly the same. They're the ones who probably just watch Netflix and eat popcorn. 3. A few very smart and slightly evil genius people get rich. And guess what? This isn't luck. It's preparation. Seriously, market downturns are like a Black Friday sale for good investments. Everything goes on discount. In this video, I'm going to spill the tea on the history of financial meltdowns so you can be prepared, grab those deals, and be person number 3. Let's get financially wild. What's a stock worth anyway? Spoiler, it's not what you think. Okay, let's play a game. How much is this fancy marker worth? $1, $10, $1,000? Honestly, it's worth whatever some random person on the street is willing to pay me for it. And going door to door trying to hawk a used marker? Hard pass. But in the stock market, it's way easier. Imagine this marker is a stock. Thousands of people are buying and selling it every single second. So its fair market price is basically a popularity contest, fluctuating constantly based on what people are willing to pay. If this marker is trading for $5, but you, in your infinite wisdom, think it's actually worth $10, you're going to snap it up, right? Bargain? But if you own it at $5 and suddenly realize it's only worth $3 in your eyes, you're going to try and dump that hot potato faster than you can say, margin call. Now here's where it gets truly wild. What if this marker is trading for $5, but you genuinely believe it's worth $1,000? Who in their right mind? You ask? Ah, my friend, history doesn't exactly repeat itself, but it sure does rhyme. The OG bubble. Tulipmania, because flowers are apparently financial gold. Picture this. The 1600s, the Netherlands. Tulips? Yes, the pretty flowers. They're new, they're exotic, they're beautiful. People start buying them because, well, they're pretty. And because everyone's buying, the prices start to go up. Suddenly, the financial types, the ones in powdered wigs and fancy breeches, start rubbing their hands together. Hold on a minute. Farmers are getting rich off these petals? We want in. But they don't want to get their hands dirty planting bulbs. Oh no, they want contracts, derivatives. We'll buy a piece of paper that says we own a tulip, thank you very much. So these fancy finance folks start creating futures contracts for tulips. More demand than supply, even if it's just demand for a promise of a tulip, and boom, prices skyrocket. They start whispering to their friends, "Psst, you gotta get in on these tulips. They're basically printing money." It got so insane, people were selling their houses, taking out loans just to buy one tulip bulb. Meanwhile, the actual farmers and merchants are looking at their fields of ridiculously valuable flowers, thinking, holy cow, we should probably sell some of these before everyone realizes they're just flowers. So they hold an auction. And guess who shows up? Nobody. Turns out people didn't actually want the tulip. They just wanted to get rich. When the reality hit that these pieces of paper for a flower weren't actually worth a mansion, the whole thing came crashing down. Bankruptcy, ruin, and a lot of very sad, very poor tulip enthusiasts. This, my friends, was Tulipmania, the first recorded financial bubble in history. Why am I telling you this bedtime story about my favorite flower? Because the exact same science of greed, speculation, and eventual panic happens again and again and again. And the people who understand it? They get filthy rich. Everyone else? Well, they get stuck with a bunch of worthless contracts for pretty flowers. Fast forward, dot-coms, houses, and the pandemic panic. Let's jump to the 1990s. The internet. Ooh, shiny new tech, the financial people exclaimed. Money poured into anything with .com at the end. You could literally start a company, slap .com on it, have no business plan, no revenue, and venture capitalists would practically throw millions at you. Companies were going public with zero profits because everyone believed the internet was the golden ticket to instant riches. Yes, the internet had merit, just like tulips were pretty. But people weren't investing in the merit, they were investing in the hype. Then, in 2000, the Federal Reserve started raising interest rates. Money got tighter, investors got cautious, and suddenly, everyone looked at these .com companies with no revenue, no plan, and billion-dollar valuations and went, uh-oh, the bubble burst. The NASDAQ, full of these tech darlings, plummeted 78%. Amazon stock fell over 90%. Again, most people lost their shirts. A few people, the ones who bought Amazon when it was basically on clearance, got incredibly rich. Then came the early 2000s, the great American homeownership dream. Everyone needs a house to get wealthy. The whispers began. Then the financial wizards got involved. Home prices only go up, right? So let's make it easy for everyone to buy a house. Enter the ninja loans. No income, no job, no assets. Seriously, you didn't even need a down payment. They'd give you 110% of the house's value so you could buy a new TV and furniture. Subprime mortgages, low requirements. Everyone was buying houses for themselves, their neighbors, their pets, their invisible friends. Why not? Prices only went up. Sound familiar? Bubble, bubble, toil, and trouble. Interest rates started to climb, and all those variable rate mortgages adjusted. Suddenly, $1,000 monthly payments became $2,000 or $3,000. Panic. People tried to sell, but there were no buyers. Houses went underwater. Foreclosures skyrocketed, and bam, the 2008 housing market collapse, leading to another stock market crash. Again, mass financial pain for many, massive wealth for a few, looking at you, Michael Burry. Even the 2020 pandemic crash was a variation on the theme, albeit triggered by a global shutdown rather than pure financial folly. Markets crashed, people panicked, sold everything, and the savvy investors swooped in, buying amazing assets at fire sale prices. Same story in 2022 when stocks fell 20%. Panic selling, massive opportunity. The 5 warning signs of an impending financial circus and how to spot them. I'm not trying to scare you, I'm trying to empower you. Because these patterns will repeat. We've had 16 recessions and 25 market crashes in the last 100 years. That's a recession every 6 years and 2 crashes a decade. It's not a question of if, but when. So how do you become the person who wins when everyone else is losing? You learn the warning signs. Here are the 5 recurring themes in every financial downturn. 1. An asset in demand. In the 1600s, it was tulips. In the 90s, internet companies. 2000s, housing. Leading up to 2020, 2022, just stocks in general. Something new, exciting, and everybody wants a piece of it. 2. Demand outpaces supply. Everyone catches on. This asset is hot. Buy, buy, buy. Prices get pushed up, up, up. 3. The financial people get involved. This is where things get spicy. They see others getting rich, so they jump in, often creating complex derivatives or new ways to invest. Think those tulip contracts or mortgage-backed securities. 4. Greed and debt. Kick in. This is the fun part. Your Uber driver starts giving you stock tips. Your barista is bragging about their crypto gains. Everyone's pouring money into something they don't understand, fueled by FOMO and often debt. They don't care about the asset itself, just the getting rich part. 5. Buyers disappear and panic ensues. Eventually, the music stops. Buyers realize prices are insane, or interest rates go up, or some other trigger hits. They stop buying. Prices stagnate, then fall. Panic sets in. Everyone rushes for the exits, and the whole thing comes crashing down. Your secret weapon, POOP. Panic, overselling, opportunity, profits. So how do you actually make money during these meltdowns? With POOP, panic. When everyone else is losing their minds and selling everything? Overselling. This panic leads to good assets being dumped at ridiculously low prices. Opportunity. This is your moment. You step in and buy those quality investments that are now on sale. P. Profits. As the market eventually recovers, and it always does, your smart buys turn into massive gains. Think about it. Pandemic crash, mass panic, overselling of stocks and crypto, opportunity for those who bought low, huge profits when markets recovered. 2008 housing crash, panic selling, foreclosures, overselling of houses and stocks, opportunity for those who bought real estate and stocks cheap, massive profits today. .com. Bust, panic. Articles saying the internet was dead, hilarious now. Overselling, Amazon stock down 90%, hello opportunity. Huge profits for savvy investors. Are we heading for more POOP, what I'm seeing now? All right, so what about today? Is the market flashing any familiar warning signs? Well, check out this headline from Yahoo Finance. The new normal, Wall Street says high stock valuations might be here to stay. For the last 100 years, the average price-to-earnings PE ratio for stocks has been around 20x. That means investors usually pay 20 times a company's annual profit to own its stock. Makes sense, right? Today, as I record this, the average PE ratio is around 27x. That's significantly higher than average. Now you have two camps. New normal people. This is just how things are now. Higher valuations. Nothing to see here. People. This looks a little bubbly. Deja vu, anyone? See those big spikes? 933, Great Depression, 2000, .com, 2007, housing crisis, 2020, pandemic. And where are we today? Right up there with some of the highest PE ratios we've ever seen. Now, I'm not here to tell you what to believe. Personal finance is personal. As they say, bulls make money, bears make money, but pigs get slaughtered. Bulls think markets go up, bears think they go down. Both can profit. The pigs, they get greedy and lose everything. But consider this headline from Deutsche Bank. Spikes in margin debt are flashing warning signs eerily reminiscent of late 1999 and mid-2007, just before the dot-com crash and the global financial crisis. Margin debt is money investors borrow to buy stocks. When that spikes, it means people are getting extra confident, perhaps too confident. The bottom line, be prepared, not panicked. Market crashes and recessions are not a myth. They are a fundamental part of our economic system. We don't know when the next one will hit. Maybe it's the national debt, maybe it's an AI bubble. I'm bullish on AI, but even I know it could get bubbly, like the dot-coms. So, what we do know is that when it happens, 1. Most people will lose money. 2. Some people will stay the same. 3. A few people will get incredibly wealthy. If you want to be in that few, you need 2 things: education, which you're getting right now, and financial preparation. Don't wait for things to go bad to start preparing. When times are good, you should be building up your capital, doing your research, and getting ready to pounce on those opportunities. That way, when the market takes a dive, you won't be panicking. You'll be strategically buying quality investments at a discount. And if you found this video helpful, the best thank you is to share it. Send it to a friend, a family member, a colleague. Let's spread the word and help more people build wealth, no matter what crazy things the market throws at us. Thanks for watching, and stay financially funny.